Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 411 on January the 23rd, 2026. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on Navitas Semiconductor Corporation, ImmunityBio Inc, Poet Technologies, and SoundHound AI. And we discuss 4 new trades on SEALSQ Corporation, Redwire Corporation, Cleanspark Inc, and Intel Corporation. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the stock market finished the short week lower. The Dow Jones Industrial Average lost 260 points, closing on Friday at 49,098 points. The S&P 500 index finished the week 24 points lower, ending at 6,915 points. And now it's time for the topic of the week. The topic of the week is practice versus theory. I do my best to cover this topic once per year or so because it's worth covering. I'm thankful that so many people listen to my show who are just starting their option trading journey. I want to help you get in the game as quickly and successfully as possible. Many people start off in the market doing theoretical trades. If you have ever spent time paper trading, that is theoretical trading. The reason it's theoretical is because you don't have any money on the line, so you're able to execute perfect trades without any emotion. You also don't experience any slippage when you're paper trading. Slippage is when the market moves against you as you're trying to enter the trade or exit the trade. Now, sometimes trades don't happen at the exact price that you hoped or planned for. So when it comes to theoretical option trading, that is like paper trading stock. You don't actually have any risk, any money at risk, and you're trading in theory. I intentionally search for trades on this show that are quite affordable. When I mention buying a spread for 60 cents, that's $60 for one spread. When I mention selling a spread at 35 cents, that's collecting $35. Because I'm typically speaking of spreads, the risk and gain are known from the start. You can practice with real trades that don't eat up all of your capital. To me, that's the best way to learn the market. Allocate a small budget to trading real spreads. In the coming weeks, I will be introducing the $500 option challenge. It will be an online video course that will focus on getting you started trading debit spreads. We will start with one strategy using a small account to practice trading options and seeing what can be done using debit spreads in the span of a month. Hopefully, some of you will join in that journey. I will also use that as an entry point to introduce the option trading group, the community I've been preparing for months now. Rather than allowing my perfectionism to further delay the launch even more, I think it's time to get started. It has been said that in theory and practice are the same, but in practice, they're not. That is definitely true in trading, especially with options. If you want to get in the game, the $500 option challenge will be a great way to start your option trading journey with real money in a small account. Now let's go ahead and get into the review of last week's trades. We're going to start off with Navitas Semiconductor Corporation. Symbol N as in November, V as in Victor, T as in Tango, S as in Sierra. At the time the stock was trading for $10.90, I looked at buying stock and selling the February 11 call at $1.20, hoping for a return of 11.93% in 5 weeks. Well, shares of Navitas Semiconductor lost 73 cents, ending the week at $10.17 per share. The call option we sold lost 33 cents, leaving us with a 40-cent net loss if we were to close the trade out immediately. Now, even though this stock has moved against us, we are still above the break-even point on the trade, meaning if the trade closed right now, we will still lock in a profit. So no need to adjust the trade at this moment. With 4 weeks left in the trade, I'm still very optimistic. Next up, we have a cash secured put. We looked at ImmunityBio Inc, symbol I as in India, B as in Bravo, R as in Romeo, X as in X-ray. At the time, the stock was trading for $5.53 per share. I looked at just selling the February 5 put at 75 cents. That could give us a return of 15% in 5 weeks. Well, shares of ImmunityBio finished the week 91 cents higher, closing at $6.44 per share on Friday. The put that we sold lost 30 cents, leaving us with a 30-cent profit if we were to close the trade out immediately. Now, 30-cent profit after 1 week represents 40% of our total possible profit, and it frees up the capital. That's a 7.2% return on the locked up capital. So the stock price is more than $2 above our break-even point. There's no need to make any adjustment on this trade at this point, but I do sometimes close a trade out early. This will certainly be a prime candidate. Next, we have the credit spread on Poet Technologies, symbol P as in Papa, O as in Oscar, E as in Echo, T as in Tango. At the time, the stock was trading for $8.30 per share. I looked at selling the February 8-7 put spread at 32 cents. That could give us a maximum possible loss of 68 cents per spread. Now, shares of Poet lost $1.40, ending the week at $6.90 per share. The out-of-the-money put spread that we sold is now in the money, which means we're losing money on this one. The stock price is well below the break-even point, so we are well justified to make an adjustment on this trade. Now, my preference is to sell a higher strike call spread against the put spread just to create an iron condor. Even if one of the spreads ultimately loses, at least we will have received a little bit of money, which lowers our overall risk on the trade. By taking in more premium, we lower our risk. So we can sell the 8.5, 9.5 call spread at 21 cents. That means we will have taken in a total of 53 cents, lowering our total possible loss from 68 cents to 47 cents. That's a little bit better. Of course, we have 4 more weeks left in this trade, and the stock price is not broken out of its higher trending effort, so it might be profitable just to be patient on this one a little longer before making a decision to adjust it. And our final trade from last week was a debit spread on SoundHound AI, symbol S as in Sierra, O as in Oscar, U as in Uniform, N as in November. At the time, the stock was trading for $11.10 per share. I looked at buying the February 10-11 call spread for 60 cents. That could give us a maximum gain of 40 cents, or that's a 66.67% return in 5 weeks. Now, shares of SoundHound lost 77 cents, ending the week at $10.33 per share. The in-the-money call spread we bought is now at the money with the stock price below our break-even price. This means we can definitely consider adjustments on it. We can sell the 10.5-11 call spread at 15 cents, shortening the long spread at 50 cents wide, and that would reduce our premium to 45 cents. Of course, that also means that we paid 45 cents for the spread, and the stock price would still be below the new break-even point. I don't like that at all. And that's the beauty of doing the math, is it stops you from making trades that look good initially, but wouldn't be great for you overall. Now, we could also sell the 10-11.5 call spread at 51 cents. That would leave us short the 11-11.5 call spread. Now, we will have paid 9 cents, reducing our current capital loss, but we could still lose 50 cents on the spread if it were to go through the 11.5 strike for a total possible loss of 59 cents. Now, that's only 1 cent less than the total amount we could lose without making any adjustments. So for that reason alone, I lean towards not making the adjustment just yet. If the stock continues to go lower, we could sell a larger call spread, thus turning our current long spread into two smaller width call spreads that are both out of the money. That's assuming the price continues to fall. Now, with 4 weeks left, we truly do have a lot more opportunities and choices on how we're going to adjust this trade, or really how we're going to react at all. Just make sure you do the math in order to confirm that the adjustment that you're making actually makes sense prior to just adjusting the trade. So that's it for the trades from last week. We're going to go ahead and get into the new trades. All trades on today's show are going to use the February 20th expiration for monthly options in February. We're going to start off with our covered call. I'm looking at SEALSQ Corporation, symbol L as in Lima, A as in Alpha, E as in Echo, S as in Sierra. The stock ended the week at $4.91 per share. I'm looking at buying stock and selling the February 5 call at 51 cents. That could give us a return of 12.22% in 4 weeks. Now you enter this trade by buying stock for $4.91 and selling the February 5 call at 51 cents. This trade makes the most money if stock prices finish above $5 per share. The break-even price on this trade is $4.40 per share. In real terms, the stock purchase will require $491, and you'll collect $51 for selling the option. Next up, we have the cash secured put. I'm looking at Redwire Corporation, symbol R as in Romeo, D as in Delta, W as in Whiskey. The stock ended the week at $12.50 per share. I'm looking at selling the February 12 half put at $1.45, hoping for a return of 11.6% in 4 weeks. You enter this trade by selling the February 12 and a half put at $1.45. This trade makes the most money if stock prices finish above $12.50 per share. The break-even price on this trade is $11.05 per share. In real terms, you'll collect $145 for selling the put option, and you'll have $1,250 locked up just in case you need to purchase the stock. Next, we have the credit spread on Cleanspark Inc., symbol C as in Charlie, L as in Lima, S as in Sierra, K as in Kilo. The stock ended the week at $13.69 per share. I'm looking at selling the February 12 half 12 put spread at 15 cents. That could give us a maximum possible loss of 35 cents per spread. Now you enter this trade by selling the February 12 half put at 89 cents and concurrently buying the February 12 put for 74 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices expire above $12.50 per share. The break-even price on this trade is $12.35 per share. In real terms, you'll receive $15 per spread that you sell and have $35 at risk. And then our final trade on today's show is going to be a debit spread on Intel Corporation, symbol I as in India, N as in November, T as in Tango, C as in Charlie. The stock ended the week at $45.07 per share. I'm looking at buying the February 44 half 45 call spread for 34 cents. That could give us a maximum gain of 16 cents, or that would be a return of 47.06% in 4 weeks. Then you enter this trade by buying the February 44 half call for $3.10 and concurrently selling the February 45 call at $2.76. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices expire above $45 per share. The break-even price on this trade is $44.84 per share. In real terms, you'll pay $34 to enter the spread, and your maximum gain is $16 per spread. So that's it for this week's show. Thanks for listening or watching if you're watching it on YouTube. Definitely shoot me an email if you have any questions about anything that was said on today's show. You guys are amazing. Hey, stay warm as well. This is the weekend of, I don't think they're calling it the polar vortex like they did years ago, but it's going to be a lot of cold weather across the U.S., so be careful, be safe, stay warm, and as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer, there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.